Yeah, day 23. So, this is, I'm recording after a while, maybe 2, 3 weeks. But let's just pick up where we left off and continue with 3.5 new trading strategies. The marriage of electronic trading mechanisms with computer technology has had far ranging impacts on trading strategies and tools. Algorithmic trading delegates trading decisions to computer programs. High frequency trading is a special class of algorithmic trading in which computer programs initiate orders in tiny fractions of a second, far faster than any human could process the information driving the trade. Let's just read that again. The marriage of electronic trading mechanisms with computer technology has had far ranging impacts on um, trading strategies and tools. Algorithmic trading delegates trading decisions to computer programs. High frequency trading is a special class of algorithmic trading in which, in which, in which computer programs initiate orders in tiny fractions of a second, far faster than any human could process the information driving the trade. So basically, we're talking about how much faster and how much more responsive um, computers are compared to humans, obviously. Um, then much of the market liquidity that was once provided by brokers, making a market a security that has been displaced by these high frequency traders. But when high frequency traders abandon the market, as in the so-called fish flash crash of 2010, liquidity can likewise evaporate in a flash. Dark pools or trading venues that preserve anonymity but also affect market liquidity. We will address these emerging issues later in this section. Algorithmic trading. Algorithmic trading is the use of computer programs to make trading decisions. Well, more than half of all equity volume in the US is believed to be initiated by computer algorithms. Many of these traders exploit very small discrepancies in security prices and entail numerous and rapid cross market price comparisons. I think we read about the flash crash being in 2010, but let's read it again. At 2:52 p.m. New York time on May 6th, 2010, the Dow Jones Industrial Average was already down about 300 points for the day. Market was demonstrating concerns about the European debt crisis and nerves were already on edge. Then in the next 5 minutes, the Dow dropped an additional 600 points. And only 20 minutes after that, it had recovered most of these 600 points. Besides the staggering intraday volatility of the broad market, trading in individual shares and ETFs was even more disrupted. The iShares uh, Russell 1000 value fund temporarily fell from $59 a share to 8 cents. Shares in the large consulting company Accenture, which had just sold for $38, traded at 1 cent only a minute or two later. At the other extreme, price quotes for Apple and Hewlett Packard HP momentarily increased to over $100,000. These markets were clearly broken. The causes of the flash crash are all still debated. An SEC report issued after the trade pointed to a $4 billion sale of market index futures contracts by a mutual fund. As market prices began to fumble, many algorithmic trading programs withdrew from the markets, and those that remained became net sellers, further pushing down equity prices. As more and more of these algorithmic traders shut down, liquidity in these markets evaporated, buyers for many stocks simply disappeared. Finally, trading was halted for a short period. When it resumed, the buyers decided to take advantage of many severely depressed stock prices, and the market rebounded almost as quickly as it had crashed. Given the intraday turbulence and the clearly distorted prices at which some traders had been at which some trades had been executed, the NYSE and the Nasdaq decided to cancel all trades that were executed more than 60% away from a reference price close to the opening price of the day. Almost 70% of these cancelled trades involved ETFs, exchange trade funds. Um, the SEC has since approved experimentation with new circuit breakers to halt trading for 5 minutes in large stocks that rise or fall by more than 10% in a 5 minute period. The idea is to prevent trading algorithms from moving share prices so quickly before human traders have a chance to determine whether those prices are moving in response to the fundamental information. The flash crash highlighted the fragility of markets in the face of huge variation in trading volume created by algorithmic traders. The potential for these high frequency traders is to withdraw from markets in periods of turbulence remains a concern, and many observers are not convinced that we are protected from future flash crashes. Let's just continue reading now. Many of these trades exploit very small discrepancies in security prices and entail numerous and rapid cross market price comparisons that are well suited to computer analysis. These strategies would not have been feasible before decimalization of the minimum tick size. Some algorithmic trades attempt to exploit very short term trends, as short as a few seconds or less. As new information about a firm or more controversially about the intentions of other traders becomes available, others use versions of pairs trading in which normal price relations between pairs or larger groups of stocks seem temporarily disrupted and offer small profit opportunities as they move back into alignment. Still others attempt to exploit discrepancies between stock prices and prices of stock index futures contracts. Some algorithmic trading involves activities akin to traditional market making. The traders seek to profit from the bid ask spread by buying a stock at the bid price and rapidly selling it at the ask price before the price can change. While this mimics the role of market maker who provides liquidity to other traders in the stock, these algorithmic traders are not registered market makers and do not have an affirmative obligation to maintain both bid and ask quotes. If they abandon a market during a period of turbulence, the shock to market liquidity can be disruptive. This seems to have been a problem during the flash crash of 2010 when the stock market encountered extreme volatility and the Dow Jones Industrial Average fell by 1,000 points before recovering around 600 points in intraday trading. The nearby box discusses this amazing and troubling episode. So we already read that. Now let's move on to high frequency trading. I'm thinking whether I should keep highlighting with the pencil because it's kind of a chore and it's not really that useful for me since I can keep reading it without the pencil, you know. But it's just like I've been doing it like this for like almost 3 chapters. So like, should I continue it or should I leave it? Because it looks very like I think I should continue it. Otherwise, I'll just like fall asleep, I think. Anyways, high frequency trading. It's easy to see that many algorithmic trading strategies require extremely rapid trade initiation and execution. High frequency trading is a subset of algorithmic trading that relies on computer programs to make extremely rapid decisions. High frequency traders compete for trades that offer very small profits, but if those opportunities are numerous enough, they can accumulate to big money. We both pointed out that no, we pointed out that one high frequency strategy we pointed out that one high frequency strategy entails a sort of money of market making, attempting to profit from the bid ask spread. Another relies on cross market arbitrage, in which even a tiny price discrepancies across the markets allow the firm to buy security at one price and simultaneously sell it slightly higher price. The comparative advantage in these strategies lies with the firms that are the quickest to identify and execute these profit opportunities. There is a tremendous premium on being the first to hit a bid or ask price. Trade execution times for high frequency traders are now measured in milliseconds, even microseconds. Uh, this has the this has induced trading firms to co-locate their trading centers next to the computer systems of the electronic exchanges. When execution or latency periods are less than a millisecond, the extra time it takes for a trade order to travel from a remote location to New York exchange would be enough to make it nearly impossible to win the trade. To understand why co-location has become a key issue, consider this calculation. Even light can travel only 186 miles in 1 millisecond. So an order originating in Chicago transmitted at the speed of light would take almost 5 milliseconds to reach New York, but ECNs today claim latency periods considerably less than 1 millisecond. So an order from Chicago could not possibly compete with one launched from a co-located facility. In some ways, co-location is a new version of an old phenomenon. Think about why, even before the advent of a telephone, so many brokerage firms originally located their headquarters in New York. They were co-locating with the NYSE so that their brokers could bring trades on foot to the exchange quickly and efficiently. Today, trades are transmitted electronically, but competition among traders for fast execution means that they need to be near the market, now embodied in computer servers, remains. Dark pools. Many large traders seek anonymity. They fear that if others see them executing a large buy or sell program, their intentions will become public and the prices will move against them. This is a particular concern with large orders that will be executed over time using several trades. Very large trades called blocks, usually defined as a trade of more than 1,000 shares, 10,000 shares, traditionally were brought to block houses, brokerage firms specializing in matching block buyers and sellers. Part of the expertise of block, wait, let me read this again. This is a particular concern with large orders that will be executed over time using several trades. Very large trades called blocks, usually defined as a trade of more than 10,000 shares, traditionally were brought to block houses, brokerage firms specializing in matching block buyers and sellers. Part of the expertise of block brokers is to identify traders who might be interested large purchase or sale given an offer. These brokers discreetly arrange large trades out of the public eye and so avoid moving prices against their clients. Block trading today has been displaced to a great extent by dark pools, private trading systems in which participants can buy or sell large blocks of securities without showing their hand. Limit orders are not visible to the general public as they would be on a conventional exchange, and traders' identities can also be kept private. Trades are not reported until after they are crossed, which limits the vulnerability to other traders anticipating one's trading program. Many large traders gravitate towards dark pools because it makes them less vulnerable to high frequency traders. They want a trading venue where other traders find it more difficult to infer their trading intentions and trade in front of them. However, this ideal has not always been realized. In 2011, Pipeline LLC, which operated a dark pool, was accused of enabling high frequency traders to participate in its markets and gauge the intentions of other participants in the pool. Similarly, in 2014, Barclays was accused of misrepresenting the level of high frequency trading in a dark pool that it operated. There are lingering concerns regarding the extent to which dark pools provide protection from other traders. They are purportedly, purportedly, supposedly, supposedly designed to offer, I don't know what that word is. Dark pools are somewhat controversial because they contribute to the fragmentation of markets. When many orders are removed from the consolidated limit order book, there are few orders left to absorb fluctuations in demand for the security, and the public price may no longer be fair in the sense that it reflects all all the potentially available information about security demand. Another approach to dealing with large trades is to split them into many small trades, each of which can be executed on in electronic markets, attempting to hide the fact that the total number of shares ultimately to be bought or sold is large. This trend has led to a rapid decline in average trade size, which today is less than 300 shares. Bond trading. In 2006, the NYSE obtained regulatory approval to expand its bond trading systems to include the debt issues of any NYSE listed fund. Until then, each bond needed to be registered before listing. Such a requirement was too onerous to justify listing most bonds. In conjunction with these new listings, the NYSE expanded its electronic bond trading platform, which is now called NYSE Bonds and is the largest centralized bond market of any US exchange. Nevertheless, the vast majority of bond trading occurs in the OTC market among bond dealers, even bonds that are actually listed on the NYSE. This market is a network of bond dealers such as Merrill Lynch, now part of Bank of America, Solomon Smith Barney, a division of Citigroup, Goldman Sachs, linked by a computer quotation system. However, because these dealers don't carry extensive inventories of the wide range of bonds that have been issued to the public, they cannot necessarily offer to sell bonds from their inventory to clients or even buy bonds for their own inventory. They may instead work to locate an investor who wishes to take the opposite side of a trade. In practice, however, the corporate bonds market is often quite thin, in that there may be few investors interested in trading a specific bond at any particular time. As a result, the bond market is subject to a type of liquidity risk, for it can be difficult to sell one's holdings quickly if the need arises. So basically, what we learned there is the bond market is very thin and has a liquidity risk. Uh, I think I'll do till that point only because I'm feeling really sleepy and my head is aching a little bit. I haven't slept all night, so that's probably why. But yeah, I just needed to record this one video and then maybe I'll get some sleep right now. I don't know. But hopefully I can record another 1 or 2 videos today. And yeah, get back to properly grinding tomorrow. I keep saying that, but then I need to get a proper night's sleep before the day. So yeah, anyways, that's it for day 23. Thanks.